Hi, welcome back to another episode of the Canadian Multifamily Investing Insider Blog. I'm Pierre-Paul Turgeon, Canada's multifamily investing authority and former insider. In case you didn't know, I used to be a Canada Mortgage and Housing Corporation, CMHC, apartment building underwriter, and now I'm a full-time successful apartment building investor myself with a portfolio of 160 doors worth over $22 million. I'm also a national speaker in the subject area, coach and trainer. In today's episode, I want to talk about how much money do you need to buy an apartment building, and that includes the down payment and other costs, as we'll see in a moment. That's a question I get a lot, and with my students, in this video, I'm going to tell you what I recommend to them, in terms of how much capital they need up front to buy an apartment building. First of all, how much down payment you need to buy an apartment building will also be a function of how you intend to finance the building, the purchase. Is it going to be through a conventional loan, conventional financing, or through a CMHC insured loan, CMHC insured financing? If you intend to finance the property through a conventional loan, well, basically the maximum loan to value is 75% of the market value. And as you may have heard in a previous blog post of mine, you'll need to provide an appraisal in support of that market value. If you intend to insure to insure the loan through CMHC, so go through CMHC insured financing, the maximum loan to value is 85% of not market value, but of CMHC's lending value. And again, from a previous blog post of mine, you would know that CMHC reserves the right to determine what their lending value will be. And usually in practice, it is somewhere between 75 to 80% of market value, despite the fact that on the face of it, it says 85% of loan to value, it's of their lending value. So in other words, if you go conventional financing, for instance, the minimum down payment is going to be 25% of market value. Whereas if you go CMHC insured financing, it's going to be somewhere between 20 and 25% of the market value. So that's for the down payment amount. However, my strong recommendation to you is you also should factor in your closing costs, roughly about 5% of your purchase price. That's what that PP is, the purchase price. And it's a rule of thumb, it's not cast in stone. But what's included in the 5% of the purchase price, in addition to your down payment, are lender or mortgage broker fees, right? Usually about 1%. It's negotiable, so you have to shop around. You'll have to spend about $2,500 on a building assessment condition report. About an equal amount for your ESA, your Phase 1 environmental site assessment. You'll have to conduct searches to make sure that the property is conforming to current bylaws, health and safety codes, and so on. So that's roughly about $1,000. You're going to need a contingency fund, right? For, bad rainy days, if you will. And that should, at bare minimum, be equivalent to 3 months of mortgage payments. Assuming 100% vacancy, that means that you can make your mortgage payments for 3 months in a row. It's unusual to have 100% vacancy, but you just never know. So you'd rather have the money there, at least bare minimum equivalent to 3 months of mortgage payments, perhaps even more. Another factor to keep in mind, it's not an actual closing cost, but it's certainly a cost that I always factor in when I purchase an apartment building, are immediate upgrades that the property will require. Again, from previous videos of mine, you might have heard me use the term REL, remaining economic life, right? And if the REL of any of the building components is not at least 5 years, you should, first of all, try to get a price reduction from the vendor if you're purchasing the property. And if not, factor them in terms of the amount of capital that you're planning to need to purchase your apartment building. So basically, the amount of capital you're going to need is not just your down payment, but it's your down payment plus these closing costs that I just mentioned. So if you go conventional financing, then that means you need at least 30% as a minimum of the market value in terms of capital upfront. And if you go CMHC insured financing, somewhere between 25 and 30% of the market value. Now, this being said, should you consider putting more than just your down payment? For example, a bigger down payment, if you will, or larger amount of capital up front. Well, things to consider in answering that question, first of all, is what are your investment goals? And secondly, where is the market in terms of market cycles? Where's the market in terms of market phases currently? So when it comes to your investment goals, for example, I mean, what are you in for? Why do you want to invest in an apartment building? Are you looking for an annual net cash flow? If that's the case, you might as well increase the amount of down payment. In other words, borrow less, because you're going to end up with more cash at the end of the day if you borrow less. If you're looking for a greater return on investment, like a cash-on-cash return on investment, then you want to put as little as possible in terms of down payment, because the more money goes in, the less is your return, your cash-on-cash return on investment. Another thing to consider in terms of your investment goals is, are you trying to reduce your investment risk, right? If that's the case, again, the less you borrow, the lower the investment risk. So then that means you should increase the amount of down payment that you put in. Now, let me look at the second consideration. Where is the market in terms of real estate cycle or real estate phases, if you will? If you're investing in an ascending market, for example, there's a rent upside, you know you're going to be able to increase your rents, therefore increase the valuation, because you're going to be able to increase your best friend, your net operating income. So then maybe it's okay to put less of a down payment, the minimum that you can figure out, because you know you're going to be able to increase the value quickly, and because the market fundamentals are very strong in your market. All right. However, keep in mind that as you do that, if you put the least amount of possible of down payment, you're increasing your investment risk. Are you ready to do that? That's something you need to answer for yourself. It's not a coach, it's not a trainer or a speaker like myself that can answer that. That's something that each investor has to answer for themselves, all right? However, if you're investing in a descending market, right? The previous here scenarios, if you're investing in an ascending market, like a market fundamentals are good and so on. But however, on the contrary, if you're investing in a descending market where the market fundamentals are not very strong, and you want to be more conservative in that particular situation, you want to basically reduce your investment risk. That means what? Put a larger down payment. So to protect yourself, and if like me you invest other people's money, you want to be conservative. So I hope you found this information useful, and I look forward to seeing you either online or one of my training programs, or in another episode of the Canadian Multifamily Investing Insider Blog. Cheers, and thank you for watching.